A new report reveals that more young home buyers are missing mortgage payments more than other age groups, older age groups. In fact, 7 times more. Let's go to Matt Fabian of TransUnion. He joins me now to talk some more about this. Thanks for coming in.
Thanks for having me.
So why are younger people more delinquent? Do we understand why?
Yeah, it's a small sample, but what's concerning is the velocity as to how quickly it's growing. And I think if we remember back to the pandemic, a lot of people started working from home, so a lot of younger consumers started purchasing homes and condos. And then we hit sort of an inflationary period and interest rate hikes, which increased the cost of mortgages, especially those that had variable and adjustable rates, very quickly. And so we call that a payment shock, and a lot of the younger consumers were facing that payment shock. And as younger consumers just entering the market, they're not at their peak earnings potential, and so struggling a little bit more to make those payments.
Okay, so when we say delinquent in payments, what does that actually mean?
In this definition, we were talking about consumers that have missed at least one monthly mortgage payment.
Okay. And my understanding is the group is a group that normally has good credit ratings, so they're not people you would expect to miss a mortgage payment.
That's what was a little bit surprising in the study that we did, is that generally speaking, younger consumers are exhibiting really good behaviors. And I think what's happening is just the combination of high inflation, high interest has kind of hit them on both sides, and it's again for a small segment of them, it's creating a lot of volatility.
So, Matt, are you seeing any similarities with the older age groups, or is this just specific to the younger age group?
Well, we've seen delinquency in mortgages go up across the board, certainly, as more and more consumers are kind of facing those same constraints. I think the difference with younger consumers is older consumers are more mature homeowners. Typically will be maybe in their prime earning years. They'll probably have some built up savings or investments they can draw upon as a backup. And additionally, they've probably built some home equity, where younger consumers generally don't have those things yet. And so when they start to hit sort of cash constraints, there's less available avenues for relief.
Got it. A severe delinquency is another metric that you look at. Can you explain what that is and tell me if you're seeing a rise in that as well?
Generally speaking, when we talk severe delinquencies, we're talking about 60 days or 90 days missed payments, depending on the type of product. And we are seeing that, generally speaking, go up in Canada across the board for the same reasons. Okay.
Unemployment, we know, in that age group, the younger age group, is much higher than it is for the older age groups. Do you think that's part of it here? I'm not sure if you get sort of translated to you that people have lost their jobs.
We know there's definitely a correlation between unemployment and delinquency rates. There's a bit of a lag. What happens typically is unemployment happens and there's a bit of a severance or some payout, then there's some EI. But when those things continue to run out, there's less and less options for consumers. And so that's when we start to see delinquencies pile up.
When was the last time you saw this kind of trend? I don't know how long you've been in this business, but would COVID have been comparable?
Actually, COVID was the reverse. We saw delinquency rates go way down for a couple of reasons: government subsidies, and lenders were offering a lot of deferrals. So they were allowing consumers to skip payments in sort of hardship relief. So probably the last time we've seen this on a regional scale was probably 2015 out in western provinces when oil prices went down. Prior to that, it would probably been around 2010, 2011. The global financial crisis is when we saw delinquency spike.
Okay, let's talk about parents often stepping in, because we know that's been part of the pattern for younger groups, is that parents either help with the down payment or help in some other way. It's a trend we've seen more of definitely in the last decade or so. Is that part of the problem here, you think, where parents maybe helped out in the beginning and are like, okay, now you handle the mortgage payments, so they're out there as a backup?
I think that could be part of it. Certainly the rules that OSFI and the banks have set up have been pretty strict around qualifying, which has kind of kept the whole mortgage market in check throughout the last few downturns that we've had. And so with parents kind of putting that down payment and they pass that first qualifying hurdle, there is a stress test on it. But again, those stress tests are only good until you hit some kind of period of unemployment or something like that. And so that's probably what we're seeing, is they're not those consumers, especially younger consumers, are not necessarily able to keep up on the payments on top of all their other obligations.
We talk about how many mortgage holders will have to renew this year with that rate still high, as you mentioned. Are you expecting things to get worse?
We're expecting things to continue to deteriorate, but not quite as quickly. When you think back to prior to the pandemic, the bank rate was at 25 basis points. Where we saw sort of the peak impact was when interest rates were about 4.5%. Mortgage rates were quite higher. We're starting to see as interest rates fall down, there's still a shock for those renewing, but it's not necessarily as impactful as maybe a year ago. But we still think with about 40%, 45% of consumers still renewing, there's going to be about a 1 or 2 year tail before it kind of all runs out.
And do you think that even a quarter point cut by the Bank of Canada makes a big difference in these scenarios?
I think it really depends on each individual situation. For some consumers, that cut might represent $50 to $100 in reduction in their minimum mortgage payment, which might be material, and for others it might not be a big deal. So I think it certainly helps.